Well, apologies for that. And many thanks once again to Courtney and to Clint for inviting us along this evening. Well, it's evening our time. I know it's sort of afternoon your time. So, but it's great to be with you. What I've put together for the second half of the presentation is really to walk you through the quantum trading dashboard, which is a collection of 4 primary indicators developed for the Forex market. I know some of you have these indicators already, but also to try and give you an insight into why we developed them, how they're developed, and how to use them appropriately within the various contexts of trading conditions. The currency strength and the slides I've put together, they are actually in the order that the indicators were developed. The 4 indicators are the currency strength indicator, the currency matrix, the currency array, and finally the currency the currency heat map. And that's the order that they were developed in. And the reason was very simple. We start with the currency strength indicator. As Anna said, this basically disassembles the market from this complex arrangement of pairs into the individual currencies, the individual building blocks of this world. And you can think of it in a way where you have any complex piece of equipment, an engine, a clock, anything you could care to think of. If you actually want to understand how it works, you need to take it apart and then build it back into its original form. And that's really what the currency strength indicator is all about. It takes this complex world and it reduces it down to the base elements of the individual currencies themselves. So that we get a very, very clear picture of not only strength and weakness, not only when currencies are overbought and oversold or moving in that direction, but also equally importantly, to identify those currencies which are of no interest to us at the moment because they're moving sideways. And all of that is revealed in this very graphical way through the prism of the currency strength indicator. Now, one of the other key elements of using the currency strength indicator, and indeed any indicator, is to use it in a multiple time frame approach. If you remember back to the trading house, we talked about time and multiple time frames. We're all used to using multiple time frame charts, but it's just as important to use a multiple time frame approach when you're using these indicators, because they reveal so much and they give you that perspective on what is going on in terms of trend development or in terms of congestion phases across a time window. Now, just to put this into context for you, I don't know whether you can see this on the screen. This is all on NinjaTrader now. And one of the beauties, as Anna said, of NinjaTrader is that the timestamp at the bottom is actually your local time. So you don't have to deduct 2 hours or add 2 hours on as you have to do with MT4 and MT5, which is a bit of a pain. And just to highlight where we are, I'll just put the little pointer on. There we go. Just wait for that to move out of the way if it is. But basically what you're looking at here is this is 8 o'clock UK time in the morning. So this is, if you like, the open of the London session at the bottom here where my pointer is. So the time period here is roughly 2 hours of UK time from 8 o'clock from the open of the London session through to around about 10:30 here. And the time frames I've got here, I've got a 5-minute on the left, I've got a 10-minute in the middle, and I've got a 15-minute over on the right-hand side. And what I've actually done to just present an example to you of how to use this is I've actually selected out and isolated out on the charts that follow, looking at primarily the British pound, which is this yellow line, which is rising very strongly, against the New Zealand dollar, which is this line here, this grey line. And the reason I've done that is because, for 2 reasons. First of all, one of the things you're looking at if you're looking for a strong trend is you are looking for pairs to go and view on the chart where one currency is rising very strongly and the counter currency is falling very strongly. Because without even looking at the chart, that will tell you straight away that there is a strong trend underway in that particular pair, in this case, the pound and New Zealand dollar. In addition to that, what this is also telling you when you're looking across the other time frames, and this is where the multiple time frame comes in, once you start to look at the 10-minute and over onto the 15-minute, what are you seeing in this time frame? You're seeing exactly the same thing. You're seeing very strong buying in the British pound, which is rising very strongly. And equally, you're seeing selling of the New Zealand dollar here. And exactly the same situation over here on the 15-minute, where again, you've got strong buying of the pound and selling of the New Zealand dollar. And what that tells you is that across that time frame, that slice of time of 15 or 20 minutes, the trend is developing from the fastest time frame through to a slower time frame. And if you think about everything logically, everything starts from the fastest time frame and gradually ripples through the market to the slowest time frame. The analogy we use a lot is of a pebble being thrown into a pond. It lands in the pond, and those ripples move out from the point that it's landed at. And it's very similar in that context to the way that a trend will develop across a time frame. If it's a strong trend, then obviously what you'll see is you will see this move out. And if we had the 30-minute and maybe out to the 60-minute, you'd be seeing the same sort of thing develop. If it's a weak trend, you're not going to see that across the time horizons. And this, in a way, is a perfect example, or as near as perfect as you could want to see. And I have to say, I just chose this at random yesterday morning, pulled it up, as I say, this was 9:15 over here through to around 10:30. It just highlights the multiple time frame aspect and also what the currency strength indicator is telling you. The inclination of the lines tell you that there is strong buying or strong selling. If lines are flat, it's telling you that a market is in congestion, and so on and so forth. And it's almost a case that you could use the CSI. The CSI is your radar on the market. It is your stepping off point, guiding you to those currencies and currency pairs of interest. It also tells you which currency pairs are of no interest whatsoever because they're moving in the congestion phase. And I'll come on to that a little bit later on. So what I've done is I've isolated these out, and we'll now go and look at the charts and just see what the charts look like. I've got 4 time frames here. Top left is 5-minute, top right is 10-minute, down onto the bottom left is 15-minute. And over onto the right-hand side, I've taken that out to a 2-hour time frame. And I've actually exploded that on the next chart, on the next slide, to full size, because I want to talk about that in a little more detail. Because again, it reinforces this aspect of using multiple time frames. We start up on the 5-minute. As I say, we've had this nice trend rise, and everything is relative. We're talking about a scalping opportunity here, but everything we talk about in terms of VPA, it doesn't matter whether you're a scalping trader, whether you're a longer term investor, it works in exactly the same way. And it's one of the beauties of applying the methodology, that it doesn't differentiate between your trading tactics. So you can be an intraday scalping trader, you can be a longer term swing or trend trader, you can be an investor on days and weeks. The principles are exactly the same. And the other beauty of the methodology is that once you've learned it, you can apply it to any market, any time frame. But in this case, we've seen this rally. This is what we're seeing on the CSI on the 5-minute. We've got exactly the same thing going on the 10-minute, and a similar sort of thing on the 15-minute. But what's interesting is once you start to look at the volume that is coming into these markets, you start to appreciate some of the nuances of VPA. In this particular case, for example, yes, we have rising volume, we have rising price action, which is what we want to see. But actually what we're seeing here on this bar here is we've got higher volume than the previous bar, which is fine. But actually, if you look at the spread of the price, we've got very limited wicks to this particular candle. But if you look at the spread of that particular candle, it's even less than this one. So if you like, what we're seeing here is we're seeing the start of an anomaly. Because all things being equal, if this rise in volume is associated with widening spreads, which is what we should see, what we're actually seeing here, this was okay, the first two candles here in this move. But then on this candle, we've got a slight narrowing of the spread. So there's a little bit of weakness. This is not heavy selling. It's just an indication that perhaps this particular trend is not as strong as we think it may be. In addition to that, referring back to the 5-minute CSI, obviously at some point that pound is going to reach an overbought state on the 5-minute CSI, and maybe that is approaching. All of that's revealed in time. But when you're using the CSI, a lot of traders tend to think of it as just a getting in mechanism. It's my way to enter the market, to find those pairs of interest and then to get in. But as we always say, if it's good enough to get you in, it's good enough to keep you in, but it'll also tell you when to get out. Because if you think about it logically, if your currency of choice has gone from oversold to overbought, or from overbought to oversold, and is now at the top or the bottom at one of the extremes, then maybe that's a point at which you should be thinking about closing that position. Perhaps not always, because it depends what happens thereafter in the slower time frames. But nevertheless, as we always say, if it's good enough to get you in, then it's good enough to get you out, and used in that way. So that's just a little indication on the 5-minute. Just to highlight something else, we've got the trend monitor running, and as you can see, the trend monitor's transitioned to blue here. We've got blue over here on 10, and we've also transitioned over to blue on 15. Just to highlight another aspect of the business of VPA, and also introduce one of the other indicators, just touch on this, is the volume point of control. And this yellow dashed line here is highlighting the fact that this is the heaviest concentration of volume on this particular time frame for this particular pair. So what that's telling us also in another way is that we're likely to see some congestion build at this point, purely because we have quite a significant concentration of volume here on the volume point of control. I don't want to dwell on that one too long, because I really want to focus on the currency dashboard itself. But that's another signal, if you will. If we move down to the 15-minute, what's the 15-minute telling us? Well, similar sort of thing as the 5-minute, if you will, because we've got volume here. This was a nice widespread up candle. Again, very, very tiny wick to the underside, no wick at all to the top side. So nice, solid price action, solid volume associated. But the next candle comes in with the same amount of volume, but on reduced spread. So all things being equal, we might expect this spread of this candle to be very, very much the same as this one, but actually it's reduced. So again, it's a nuanced way of looking at it, and just starting to read those slightly more subtle signals, if you will, of VPA. As I say, I've actually exploded this chart on the next slide, so I'm just going to move this one on. This is the 120. And bear in mind, of course, that we're now on a 2-hour chart, so we are crossing sessions here. We're moving out of a Far East Asia session, and we're moving into a London session. But what this is telling us pretty clear is that we've seen the market fall here, but we've got falling volume here. And then on this candle, we see the volume rising. This is sort of early part European session, and we've got a narrow spread. So we've got an anomaly. So potentially we've got some buying coming into this market because the spread is narrow, the volume has risen. And on the next candle, we're seeing that reinforced. We've had a deep move to the downside, nice deep wick to the bottom of the candle. Nice spread, little narrow spread on the candle itself, but a lot of volume coming into the market. And this, of course, is London opening up. And as we see that coming in, we've also got a pivot here to the underside. What we're seeing reflected is we are seeing buying coming into that market around this region, and that's reflected in this move higher, which was taking the pair through this region of what was resistance and is now acting as a minor platform of support. Now, obviously, whether that is enough to develop this trend further, then again, only time will tell. But the other aspect to this also is really when you start to look at slower timeframes out from whatever perspective of time you are focused on, and it's very hard at times to, forgive the pun, but it's very hard at times to really limit yourself. We've used a lot of analogies over the years. One of them is a horse racing analogy, where I'm sure you've seen it at the racetrack, where horses are blinkered. They're blinkered because they race better if they're focused on the finishing line and nothing else. And in a way, as a trader, that's what you have to do. You can be a scalping trader, you can be a trend trader, you can be a swing trader, all these different time horizons at different points during the day. But when you go into the market, you have to have a clear focus of what it is you're trying to do. Am I scalping this market? Am I going to be in for a few minutes? Or am I looking at this as a longer-term trend opportunity or trading opportunity? We've all done it. It's very easy to open a position in the market. It doesn't go in the way we anticipate it, and we then look at slower timeframes for confirmation, and we look down the charts and we go, oh, well, actually, you know what? I think down in the 3 or 4 hour, I think I might be all right, so I'll hold it for the time being, and so on and so forth. We've all done it. It's very easy to do. We're all human, for goodness sake. It's not a criticism of anybody. It's just a fact of life. We have to deal with that, and it's hard. It's very hard to define your field of vision, if you will, for that particular trading opportunity. But when you're using a slower time frame in this way, what you're looking for is what is the dominant trend. And in this case, you can see from the trend monitor, it's not a strong trend, but the trend right now for the pound New Zealand has been bullish, and it's been bullish for a couple of days or so. So that's not an argument to say, well, I shouldn't trade the short side for this particular pair. But it just gives you another perspective on what it is you're doing in your time horizon versus what is going on in a slower time horizon. So that's the CSI. So that was the first indicator that we developed to help with this whole business of revealing the constant oscillation from overbought to oversold and back again, which goes on in all time frames, from the fastest chart, from the seconds right the way through to the days and weeks and months. The currency matrix was the second one. And we developed this because if you imagine looking at a single chart, you're looking at, let's say, a euro-dollar chart, and that particular currency pair is rising. Is that rising because the entire market is buying euro and selling dollar? Is it rising because the entire market is buying euro strongly, but the dollar is not doing anything particular? Or is it rising because the euro isn't doing anything particular, but the dollar is being sold off heavily? And finally, is everyone buying the euro and selling the dollar or not? And those are the questions that you try to answer in your mind. And what we developed was the currency matrix, because what this is a matrix of the pairs associated with the currency that you are focused on. And what I've done here is to isolate out, first of all, the pound, and on the next slide, I've isolated out the New Zealand dollar. And what this tells you instantly from the ranking on the ladder is that, without exception, on the 5-minute time horizon, the market is buying pounds. There's no question about it. This is a perfect array. Everything is ranked at the top, and the euro pound, with the pound as the counter currency, is down the bottom. So the market universally right now, for whatever reason, that may be political, it may be a Brexit, it could be something's happened in Europe, someone said something about Brexit, could be fundamental news, could be anything. It doesn't matter what the driver is. The fact of the matter is the market is buying pounds right now. Is that true on 10-minute? Exactly the same. It's a perfect array. All the pound pairs with the primary currency at the top and the euro pound at the bottom. And exactly the same over on 15. It's not quite perfect on 15. You've got the euro New Zealand sat in there for whatever reason. And the euro pound is certainly well off the bottom here. But from a perspective across a 5 to 15-minute time horizon, it looks pretty much universally that everyone is buying the pound for whatever reason. And that's the visual display. So that's the first part of the equation. Obviously, the second part of the equation you want to understand is, well, what's going on with the other side of the currency, which is the New Zealand dollar. So here we've got the New Zealand dollar isolated out, again on 5, 10, and 15 with the matrix. And it's not such a clear picture, because you've got some mixed messages here. You've got, for example, here you've got the New Zealand dollar, which is pretty high up. So we've got the market here is buying New Zealand and selling dollar, and yet on the pound New Zealand, we're buying pound and selling dollar. selling New Zealand dollar. So there's mixed messages in here. We've got similar sort of mixed messages in here, and we've got a patchy. This is slightly more developed on the 15-minute, but nevertheless, it's not as universal as for the pound. And what that tells you is that in trading the pound New Zealand, it is the dominant buying of the British pound that is primarily driving this market. Yes, there is New Zealand dollar selling, but it's not as consistent and as solid as the pound buying. And it's important that you understand that, because the ideal, of course, is that you want to have a perfect balance between your primary currency and your counter currency, in which case you'll have a very, very strong trend. It happens, not always, but it happens. But generally what you'll find is that one currency on either side is really driving that particular currency hard. And then it's a question of deciding, which is really where the currency array steps in. It's trying to decide, well, which is my best currency pair to be trading? I understand what is going on in the market right now with buying of the pound, but should I be buying, the pound yen? Should I be buying pound New Zealand? Which pair is going to give me the best opportunity with the lowest risk? And really, that's what it's about in terms of the currency array. So that's the currency matrix. So having developed the currency matrix, the third component, if you will, was really to present a graphical display where we're now dealing with currency pairs, whereas with the currency strength indicator, you're dealing with individual currencies and whether they are moving to overbought and oversold. We're now in currency pairs where we're looking at potentially overbought and oversold situations for the currency pair itself. But moreover, we want to identify and see which of the currency pairs are trending the most strongly. Where is the momentum? Where is the strongest momentum in the pairs that we're considering? Is it the pound New Zealand? Now, in this case, as you can see on 5, pound New Zealand was certainly the strongest. Pound yen would have been another one potentially to consider. But obviously, in looking at the pound yen, you'd then be looking at the yen as the counter currency, because what you might find there is that the yen is actually quite weak, and it is purely this solid buying of the pound which is driving it. Whereas in the pound New Zealand, you've also got New Zealand selling. So it's a balance. It's always a balance between finding which currency pair is going to give you the best and lowest risk opportunity for the greatest potential. But again, you can see over here on the ranking, we've got pretty much a uniformity in terms of pound buying over onto 10-minute, over onto 15-minute, shaping up in pretty much the same way. But what these lines reveal is the strength of trend and momentum in those particular pairs. And you can see over on 10 and 15, it's the pound yen which is really moving, and the pound New Zealand is actually second or third in the ranking there. And one of the great ways of using the array is to actually set it up with the yen pair, because the yen is always the counter currency in that particular complex. And what you'll see in looking at it with the yen pairs is that all of these will either sweep to the upside and sweep to the downside en masse. And if there's any divergence, then it's instantly obvious. It's a little bit more, I would say, complex. It's a little bit, you just have to accept the fact that obviously down here we've got euro pound, because the pound is the counter currency. So it's a little bit more difficult to visualize. But when you're looking at the yen complex, they all sweep up and down together. You can isolate them out with the buttons, as I've done here. And the other thing with the ranking ladder here is alongside it, this gives us a heads up as to when currency pairs are potentially moving into either overbought or oversold state. When they're approaching an overbought state, then the color is a darker blue in brackets, and when they have arrived at a potentially overbought state, then it goes to bright blue, and equally at the bottom to bright red. So that's with the pound isolated out. And if we go on to the other side of the equation, we go back to the New Zealand dollar, and as you would expect, it's a mixed picture. Again, it just confirms what is going on here. Yes, we've got some trend in the pound New Zealand. Yes, it's fine up here. Yes, it's fine up here. There's a trading opportunity. Is it the best trading opportunity? And that's what you have to unpick the whole time. Is it the right one to choose? And is now the right time to get into that particular trend as it develops. And finally, the fourth element that makes up the currency dashboard is the currency heat map. And again, what I've done here is I've just isolated out the pound on this occasion. And what we wanted to try and do with the currency heat map was to present this complex world in a single chart, which allows you to see visually and quickly those changes in sentiment as they ripple through across the time horizons. And this is actually a nice example with the pound, because despite the fact, and I'll come back to this in a moment, this ranking ladder here carries weight. And they are weighted by these time frames up here. But let me just focus on these cells for a minute, because despite the fact that you've got a pound Aussie at the top and a pound yen at the bottom, what you're also seeing across each of these is the bullish sentiment towards the pound reflected in this rippling effect that I mentioned earlier on. It's moving out from the faster time frames and it's starting to move into the slower time frames. You can see it here in the pound yen. Very it's minor bearish sentiment here on the 1 minute, but then as you move out into the slightly slower time frames in inverted commas, you'll see these all turning green, and you're seeing it all the way through here and even over here and also up to the top here. So it's a visual way to get a sense of changes in sentiment from bullish to bearish, bearish to bullish. And the data here is derived from the currency matrix and presented in these cells to help you visualize all these without having 250 odd charts littered across all the various time frames. This really does it all for you. It condenses it down into one single chart, one single heat map on which you can monitor the changes through the various time frames. So it's a great way to visualize changes in sentiment, which is obviously reinforced from the currency strength indicator, the array and the matrix and everything else, putting it all together, and the charts themselves, of course, and VPA. The other aspect to the heat map, which perhaps is less obvious, is that the currency pairs here are all ranked by a weighting of the time frame. If you think about it logically, a monthly time frame should have greater weighting than a 1 minute time frame in terms of where a pair might rank against all the other 27 pairs. And that's what we've done in the heat map, is to actually weight those according to the time frame. So what you will see on the ranking ladder here is very different to what you'll see on the matrix and the array. Well, they will move up and down very quickly. What you'll see here is these currency pairs will move. They will move within the day. They might move 1 or 2 or perhaps three slots, something like that. But they'll move much more slowly. So the heat map, if you will, is a combination of two different styles. It's a combination of instantly what is going on in terms of sentiment across the various timeframes and cells thereon, which is then reflected in the ranking of the currency pairs. Now, one of the great ways of using the heat map is to actually use it in a very similar way to one might apply a tactic to the currency strength indicator, where you're looking at extremes, for example. So, and I have to confess that my eye is always drawn to the top and bottom, whether I'm looking at the heat map or whether I'm looking at the currency strength indicator. I'm always looking for those extremes, those reversals, because I like to get into a trade early. Now, getting into a trade early comes at a price, and the price you pay in the market is a wider stop loss, because you have to allow time for that position to develop. And as Anna said, currencies can stay overbought and oversold for an awful long time, but they will reverse at some point. They have to. They can't stay overbought or oversold forever. They have to move from those regions. It's just a fact of life. But that comes at a price, and that price is patience. So you have to be patient and wait. And you also have to set a wider stop loss to allow for that time, because what you'll see is you'll see a currency or a currency pair will oscillate around a region for quite some time, and then the move will start. The advantage, the payoff, if you will, is that you've got into that trading position early. And all trading is about risk and reward. If you're prepared to put more risk on the table, then the reward is higher. So if you're a reversal trader, the cost to you is higher in terms of placing your stop loss because it's got to be wider. But the payoff is you take a much, much bigger chunk of any trend that develops thereafter. If you're a trend trader and you want to jump into an existing trend, then you're going to wait for the trend to start. The payoff is much, or the risk is much smaller because you're going to put a tighter stop loss on because the trend is already underway. So there's momentum in the move. You're jumping onto a moving train, but the payoff is lower because you've missed maybe a third of the move already. That's gone and dusted. You're taking out perhaps a chunk in the middle. It's all risk and reward, but it's a great way to use the currency heat map in that way. But just remember, this ranking ladder is weighted. So we've got the Aussie yen at the moment, which is down at the bottom, and we've got the Euro Aussie up at the top. So if you're prepared to take a position in the market, which may last for several hours and may go over, as we do, into 2, 3, 4 days at a time, then that's fine, and that's a great way to use the currency heat map in terms of the ranking here. But the other way to use the heat map is really just as a straight visual on what is going on in terms of market sentiment for the pair you're considering, and whether it's rippling through and out from the faster timeframes and out into the slower timeframes, wherever your time window may be. The reason this is purple is because one of the features we have on the heat map is a bookmark function. So you can actually bookmark and highlight those particular pairs that you're of interest or that you are trading at the market. So those are basically the 4 key indicators and why we developed them in the way we did. And they make up the currency dashboard. Now let's move on to look at something else, because we all look at trends, we all look at reversal opportunities. We're always looking to take opportunities, jump on a trend or take a reversal trade. But what the currency strength indicator will also tell you, and maybe this isn't quite so obvious, it will tell you when markets are in congestion. And it does that because when you see 2 currencies which are either rising or falling together, and the pair that I've chosen here is the dollar yen. The dollar is this red line. The yen is this magenta line. And I've done that because you're seeing that across the time horizons. We've got 5, 10, and 15 again. We've got the dollar here and the yen, and we've got the dollar here and the yen also. If I'm looking at the currency strength indicator and I'm seeing that in play, then I'm really not interested in the dollar yen as a trading opportunity, certainly from a trend trading perspective at any rate, because I know for a fact that the 2 currencies are moving together, and therefore there's not going to be a trend there. It's as simple as that. You can think of it in many different ways. Perhaps the best analogy is 2 parallel train tracks where you've got 2 trains maybe leaving the station at similar times, and they're both running in the same direction. There may be some differential speed between the 2, so you might have one which is moving slightly faster than the other, and you might have a very minor trend building on that particular chart. But rest assured, it is not going to have any strength. It will only have strength if, for example, the yen here continued falling strongly and the dollar was to reverse and start moving in this direction. Then you would have a trend underway. But as it stands right now, there is no trend on the dollar yen on this particular time horizon. And equally, the same would apply. You could look at this as the Swiss franc, which is the green line. This is the Aussie dollar. These 2 lines are falling. There's nothing much happening. It's probably in congestion, not going anywhere. But then as they cross, now we've got strong buying coming into the Aussie dollar, the blue line. And it may well be worth looking at the Swiss franc on that occasion, because you're also starting to see that over here. The Aussie is starting to rise. The Swiss franc still falling quite strongly. Really hasn't started to develop very much over here, other than you've got heavy selling of the Swiss franc. Now, in terms of heavy selling of the Swiss franc, that may be enough to generate a trend, but it still is not going to be strong enough to do anything particular against the Aussie dollar when you've got it moving in the same direction. So the pair I've pulled out here is, as I say, is the dollar yen. It is these 2 lines here. They're moving together, and therefore you don't expect to see a trend. So when we go and look at the charts, this is what we see. This is dollar yen on 5, 10-minute on the right, 15-minute, And I've gone down to the 120 minute over here. We're in congestion. Is this something we want to trade right now? No, not particularly, for lots and lots of different reasons. It's in congestion on 5, over on 10. Similar sort of picture. We've got pivots to the upside. We've got a lot of, this is a potential platform of support. We've got the volume point of control here again, this heavy dashed yellow line. So, we know we're trading around a pretty severe area of volume, so we're not expecting much to happen. We go down onto the 15-minute. There's yet a further reason that we're expecting congestion, because we had a volatility triggered here. This is triggered on the average true range. It's basically looking at the anticipated expected range of price action, if you will, for that particular pair at that particular time of day. And what's occurred is we've had the volatility, we've had a snap in the market. No doubt many traders have jumped in, they've seen that. And the beauty of the indicator is, as Anna said, it triggers in real time. So as soon as this price action's hit the measure of average true range for a certain number of candles, then it will trigger and it will tell you instantly that there's volatility. When you see volatility, you can be assured the market makers will be there. They will be trapping traders on the fear of missing out. It's that simple. And what happens thereafter is that the pressure of time then comes to bear, because as a trader, what you don't want to be is taking a position and then you're under pressure. You are being squeezed emotionally through this phase of price action because you're hoping it's going to recover, but you just don't know. You may have been taken out, but rest assured you'll probably close out because you just don't know and you're frightened that the market's going to collapse. But again, you're trading around the volume point of control. And right the way over to the 120 minute, again, it's really just confirming what you're seeing on the chart. You are seeing the market trading around this yellow line, the volume point of control. You've got a ton of resistance overhead. You've got some support below. You've got spiky price action throughout. It's really not going anywhere fast for the immediate next period of the session. And really, to reinforce that, I've done exactly the same exercise with the matrix. So I've isolated out the yen pairs, and I've also done the same with the dollar on the next slide. And really, that's just reinforcing what you're seeing on the chart. The reason the pound yen is up at the top, we know, because the pound is driving that particular pair. But as far as the rest of them are concerned, we've got the pound yen up here as well, and we've got the pound yen up here again. But as far as the rest of them are concerned, it's all pretty mixed. There's no strong bias. And certainly as far as the dollar is concerned, which is the next slide here on the matrix, again, the same time frames, 5, 10, and 15. You've got a similar sort of picture. And again, it's mixed. You've got the Aussie dollar here, the New Zealand dollar. Here's the dollar yen. So we've got buying of the dollar and selling of the yen. We've got selling of the dollar against the pound. We've got selling of the dollar against the Aussie. We've got some very strong selling against the dollar Swiss here. But then, as I highlighted before, with the Swiss franc falling strongly, that's what's driving that market. So I hope you can start to see that through this complex world, when you start to think about the pairs in this way and unpick them in this way and start to look at them from both sides, using the matrix, using the array, then it helps you to understand what are the drivers for that particular pair. Is it stronger on one side or the other? And from that, to be able to decide whether that is a pair that you want to take a position in or not. Because that's all it comes down to, is simply making a decision based on risk, your risk assessment of taking that position in the market. And the problem most Forex traders face, and indeed traders in all markets, but particularly in the Forex market, because it is unique, is they don't appreciate what it is they're doing. And if a currency pair is rising, they automatically assume that every other market for that pair is rising, or that currency at any rate is rising in the same direction. And that is generally not the case. And again, walking through to the array, from the matrix to the array, as I said, the yen complex is a great complex to practice this on, because the yen is always the counter currency. So as I said earlier, if you're seeing strong buying or strong selling in the yen, which we're always looking for in terms of sentiment, because it is a real strong sentiment indicator, then you get this very simple arrangement where all the pairs all the brothers and sisters of the pound yen start to rise up. And it's almost like a windscreen wiper on a car. As the market gathers strength and the trend starts to develop, you see all these sweeping up. And I tell you, it's a great way to be trading, because it gives you such confidence that what you're seeing on the chart is also being reflected across all the other pairs, and they're all moving in the same direction. It's just giving you, again, that heads up that market sentiment towards that particular currency is universal. And also the strength of that universality, if I can say the word. And finally, here we are. We've isolated out the dollar, and again, it's a little bit of a mixed picture. It's not terribly strong. The dollar yen's sat here. We've got the dollar yen in the middle, and it's not a picture where you can say, well, yeah, it's really strong buying or really strong selling of the dollar. In fact, the 15-minute is probably giving a decent picture down here, certainly with the Aussie dollar, New Zealand dollar, and Euro dollar lining up down here. And of course, the other thing you've got to remember is when you're looking at the matrix, ultimately what may happen, of course, this will depend on what's going on in the chart and the currency strength indicator and everything else, and the volume associated. Ultimately, what you may be witnessing here is all these pairs marching up to the bottom, or down up to the top, or down to the bottom, and arriving at that perfect combination where they are perfectly stacked, as we saw them on the initial example with the pound New Zealand. That's the ideal. When you see very strong buying and selling, that's what you will see. But obviously, in arriving at that point, then these have all got to march up to the top and these down to the bottom, or whichever pairs are under consideration.